Good morning. My name is Simone Parker, and I'm with our stakeholder relations team. It's our privilege today to host a webinar on our asset liability management process. Before we get started, let me cover some housekeeping items. First, as a reminder, this webinar is being recorded and will be archived on our YouTube page in the coming week. Shortly, the team will provide a copy of the slides in the chat for you to follow along. If you have questions, as time permits, you can raise your virtual hand and we will call on you at the end of the webinar. You can find this feature at the bottom of the screen under the React, which is the heart icon, or you can type your questions in the question box. We only have an hour today, so we'll try to answer as many questions as time permits. If you need closed captioning, you can also click the Show Captions icon at the bottom of your screen to show those. So what's on the agenda today? We'll give you a brief overview of our asset liability management process. We'll talk to you about what's new for this year. And we will also go over how the ALM cycle impacts our members and employers. We'll also take a look ahead at the decision that will be going to the board in November. So today we're joined by our Chief Operating Investment Officer, Michael Cohen, and Chief Actuary, Scott Tarando. I'll now pass the virtual microphone over to Michael Cohen so he can get to the real reason why you've all joined us today. Go ahead, Michael.
Thanks, Simone. Appreciate it. And thanks, everyone, for joining us. So for those of you who've been following CalPERS for a while, you'll recognize the asset liability management process that we do every 4 years. And we're in the middle of it in 2025. As the calendar shows, we've already done sessions with our board in April, June, and July. You're always free to go back on our YouTube channel and watch those. That being said, the purpose of today's webinar is really to catch you up on what you've missed. So ideally, you won't need to do that. So Jeremiah, if you can go to the next slide for us. This is just a quick recap of what the ALM is. As I mentioned, it's a 4-year review cycle. We do a mid-cycle review. So basically every 2 years, we're checking in. And the way I like to describe the ALM process is really kicking the tires on all of the assumptions underlying the key financial components of our investment and actuarial offices. And really it's the CFO, Michelle Nix, who coordinates this process. She wasn't able to join us today, but ultimately she's kind of the quarterback of our ALM process. So if we can go to the next slide. The purpose of the ALM really ties nicely to the goal of the system, which as part of our strategic plan is obviously to maintain pension sustainability long-term. We know all of you and all of your employees have been promised benefits when you join your organizations, and it's CalPERS's job to make sure that we're able to deliver those benefits to you long-term, all the way through retirement and beyond. So that ultimately, that's why we're here. So the new to ALM this year is really associated with the onboarding of our new Chief Investment Officer, Stephen Gilmore from New Zealand, is the notion of a total portfolio approach. Traditionally, we've kind of used the ALM to develop a strategic asset allocation, which divides up each of our allocations of our now $550 billion of assets into various asset classes like stocks, bonds, private equity, real estate, infrastructure, and so forth. The focus of a total portfolio approach is really about thinking these as a total fund in coordination with one another, how one asset class might interact with another, making sure we are using a common set of language, a common strategy, and ultimately, rather than just sort of focused on, oh, we set the asset allocation, being more agile and flexible in the way we think about our investments. And the bottom line on all of this is the same as it's always been, that we think we can get better investment performance by moving to this approach, being more agile, taking advantage of opportunities. And as I think all of you know, the better we do performance wise, the lower costs are going to be on our employers. And that's, we're now up to 79% funded. Our goal is always to get to 100% funded. And when we do that, employer local government costs are going to go down because you're no longer paying off the unfunded liability of the system. So let's get a little bit more into the difference between strategic asset allocation and total portfolio approach. Really, we've focused on what this means to the board as our governing body and our decision making. Obviously, there's more differences that are internal to our investment office, how we are going to make decisions on a day-to-day basis and how we run the office. But from a big picture governance standpoint, it comes down to two main things, which is the reference portfolio and the active risk limit. The asset allocation traditional way, as I mentioned, is really sort of saying, okay, we're going to put 17% of our money into private equity. We're going to put 40% into stocks. We're going to put 20% into bonds, those kind of decisions. And instead, we move to, under a total portfolio approach, this notion of a reference portfolio. The simplest way to think about a reference portfolio is just kind of a passive index, like you might invest in a mutual fund, where you say, you know what, I want to put 70% of my money into equities, meaning stocks, and I want to put 30% into bonds. And so that's kind of your simplest investment approach that we theoretically could put in. But that if all we were doing was a completely passive investment only in publicly available stocks and bonds, you would ask the question, well, what is the 300 people working for the investment office actually get us? And that ultimately is why we're here as an investment office at CalPERS, is because we know that we can do better than a simple equity bond approach. And ultimately, what total portfolio approach does is gets our board the ability to hold us accountable, saying, okay, the reference portfolio produced 9% returns this past year. Are you above 9% or are you below 9%? And if you're above 9%, great. And if you're below, how come you're not what decisions did you make that didn't turn out that lead us to be underperforming this reference portfolio? And the second, once we sort of set the risk appetite through a reference portfolio, which is right now somewhere between 70 and 75% bond or equities, and the remaining part 25 to 30% bonds, we then take active risk over and above the reference portfolio. And that's really when we start getting into the private markets. We deviate from the simplest allocation of stocks and bonds and figure out ways where we can add value to the portfolio. Ultimately, the risk becomes much more transparent because every time we make an investment decision, it's going to get reflected as a deviation from this portfolio, basically this passive, the simplest way to invest. And then it becomes obvious where we're taking risk, where we've made decisions to deviate from the reference portfolio. So with that, why don't we move on to the next slide, where we have been talking a lot about active risk with our board. And here, I think it's a matter of terminology change, that in today's asset allocation world, even though we are taking risk when we put money into private equity, real estate, infrastructure, or private debt, we don't really call it active risk because it's been allocated by our board into the various asset classes. So instead, what you'll start seeing, assuming our board approves this total portfolio approach later this year, would be us talking about the entirety of our risk that we're taking that's deviating from the simple passive approach. So the term tracking error is what we use right now, but really the only tracking error that shows up in our board reporting is where we've decided to take an active bet in the stock market, where we've given money to some of our partners to say, hey, go take a strategy to deviate from a passive portfolio. That gets listed as tracking error and active risk. But instead, what would happen under our total portfolio approach is everything deviating from that reference portfolio will be showing up as active risk. So just to go a little bit deeper on this, basically the bottom line is we've assured the board that all we're doing is converting discretion that the board has already given us and rearranging it into a slightly different terminology, a slightly different approach. So you see on the chart here on the far right, basically under the various authority and discretion that we have today, we could deviate from what the board approves by up to 400 basis points. So 4% of the total portfolio away. And that's because when they tell us to invest in private equity at 17% of the portfolio, we have the ability to go up to 20 or 22% or go down to 12% of the portfolio. So when you add up all of those things, our best estimate is we could actually deviate a huge amount from the strategic asset allocation that the board's approved. So you see here in the dotted box that we don't foresee going anywhere near the full limits of the discretion that we have under today's approach. And instead, and this will be part of the board discussion, is we anticipate sort of a range of somewhere between 250 and 350 basis points of discretion. That'll be one of the key decisions for the board to tell us, okay, here's what we expect you to start with as a reference portfolio, but we know you're going to deviate from that number in some way. Some of those deviations will continue in the private asset classes. Those commitments tend to be long-term, and other, movements from the reference portfolio will be new decisions that we think we can, where we see opportunities in the marketplace to make more money. That's where we'll deviate. So that's kind of the simplest way we figured out how to show that we're not seeking any new discretion from the board, but we are rearranging that discretion. And we think because of the rearrangement, we're going to be able to be much better able to actually utilize it and encourage our team to take risk where we're going to get paid off. So let's move to the next slide. I think this is really the core of what all of you are going to want to see. So the reference portfolio, again, this is just publicly available stocks and bonds. You can see the capital market assumptions, and we've talked about these in prior years, sort of what do experts forecast over the long term that a simple 70-30 portfolio would deliver. Right now they're saying 6.2% in the first column, but then we think we can do better than that, as I've mentioned, from investing in private asset classes, making active decisions on the stock market or on bonds. And that's going to be, as you can see across the second line, sort of between 0.6 and 0.7%. So when you add up the projected reference portfolio returns and the value add from deviating from that reference portfolio, in all cases, we think we're going to, at a minimum, hit 6.8% over the long term, which many of you know our discount rate is 6.8%. So as long as we hit 6.8% on average over the long term, your rates are going to continue to come down as we pay off our unfunded liability. So that, I think, is the most important takeaway from this webinar for you as a financial manager of a local government, or those of you interested in retirement, is we see nothing right now that would change the discount rate from anything off of 6.8%. So while total portfolio approach is a fairly big change for our board, and particularly for the investment office in the way we approach investing, trying to be more agile, take advantage of those investment opportunities that come around in between our asset allocation decision making from a stakeholder perspective, from a local government perspective, We think that there's real upside here, that over the long term, we're much more likely to hit the discount rate consistently, and as a result, your rates will come down. But right now, we see no momentum to change the discount rate from its current 6.8%. And this next slide just gets into a little bit on liquidity. Obviously, you want, as a member of CalPERS, to make sure that we have enough cash on hand to pay you your pension as it's due every month. That's the absolute worst thing that can happen from a pension management standpoint, is not having enough cash to pay the pensions. So this was our attempt at visualizing for our board really how we think about liquidity. We have spent a tremendous amount of time and effort since the Great Recession in the 2008, 2009 timeline. How do we make sure that we have enough money, both, as I said, to pay our pensions, and also have enough money where we don't have to sell off those investments that we really like for the long term, sell them off earlier than we would prefer. So the blue area here is kind of where we expect to operate for the most part on a daily, annual, monthly basis. But we think there is extra capacity within the system to go out in the white area to that red dotted line. And then even within that is the gray box. Basically, we don't really want to move into the margin of safety, that we have built in controls so that we're very comfortable that we're always going to have enough liquidity on hand, even if something unexpected happens. If we hit another Great Recession or cosmic type event, we would still have enough liquidity to pay all of our pensions and still operate at an efficient level. So that's the point of this sort of chart, is just that we are thinking a lot about our liquidity and making sure that we have enough resources and cash on hand to continue to operate for the long term. And that's really one of the CalPERS investment office advantages, that we can think longer term than many of our other colleagues who are out in the investing world. That being said, we know we need to pay our benefits every month. So with that, let me turn, excuse me, a little bit to board reporting. We spent some time with our board earlier this week talking through this, and ultimately our goal is to make the reports that we provide to the board and the public more transparent, simpler to understand, and ultimately more useful. I think the bottom line was the point I made earlier, that we think better reporting will make it easier for the investment office to be held accountable, to really justify our existence, to prove that we are adding value. Because if we're not adding value, then we really could go with a long-term passive approach that would only require a handful of investment professionals to manage the money. So the board reports is where there will be some changes. There's also a terminology change that I think you'll start seeing, assuming our board approves the total portfolio approach. And that's, right now we use asset class as our main point of focus, where we kind of do these annual program reviews with our fixed income group, with our private groups, with our public equity groups, and all of those will become mixed into our annual review that we provide the board, to really have a complete view of what's going on in the portfolio. But moving away from kind of asset classes, we'll start talking about strategies, and that it might still be within our private equity team, but they're going to have a sub strategy, so call it venture within there. And so those types of strategies that we're undertaking within a various asset class, we'll do more in-depth strategy reviews throughout the year. So continue to provide our board the opportunity to ask us questions about how we're approaching investing, but also have this big picture view at least once a year, where everything comes together and we can provide the big picture, how we've chosen to deviate from the reference portfolio. And then finally, at the bottom of the slide is just the notion that all of our standards-based reports aren't going to change at all. We're not going to change the information we provide in our annual audit, in our annual investment review, and there are these GIPS investment standards that we rely on to determine how we report our returns, and none of that is going to change. And really, the GIPS is where we make sure everything's apples to apples, so we don't report our returns on anything other than net returns. So when people talk about fees in our various investment vehicles, absolutely we pay fees, but we always report how we're doing on a net basis after you've accounted for the fees. So with that, that's kind of the big picture review of total portfolio approach. I'm going to turn it over to Scott Tarando, our chief actuary, to run you through the experience study and what's coming on the actuarial side.
Hey, thanks, Michael. As Michael just mentioned, another part of the ALM process is the experience study. And that's where the actuarial office takes a look at all the demographic assumptions and economic assumptions that we use in establishing both liabilities and the required contribution rates. As you can see, we kind of have broken them down on this page into the economic and non-economic assumptions. Primarily, the economic assumptions are a bigger driver in terms of costs and changes. Discount rate, inflation, the investment return, those actually, they tend to have a bigger impact on both the liabilities and the required contributions that the employers pay. On the non-economic side, there are a number of them: retirement, termination, longevity, mortality, how long people are living. Generally, these in the recent past haven't had a big change or a big impact on contributions or liabilities. We did make a substantial change to the mortality assumption about around 2011 or so, and that was a fairly significant change. But since that point in time, the adjustments have been pretty modest. Obviously, when we're looking at these type of assumptions, we want to take a long-term expectation, and we try to avoid any short-term fluctuations. Taking into consideration the COVID years and that occurred, a few years ago, primarily what we've noticed is there were some spikes in retirements and spikes in mortality that really didn't play out in terms of long-term expectations. And so in this experience study, we are primarily excluding a lot of the COVID years experience just because it kind of stands out as more an anomaly versus the long-term trends and what we're seeing. Next slide. So what do our assumptions impact, in terms of employers and liabilities? Obviously the funded status, the liabilities, normal cost contribution rates, and as a corollary to the contribution rates and the normal cost of PEPR member contribution rates. So where we are with the experience today is we've wrapped up our analysis, and we have developed our proposed assumptions that we'll be taking to the board in September. We're also, at this point, we've sent them out and having a third-party actuarial firm review the process and our recommendations. So that's going on right now. And we are also just starting in the process of determining the impact that these change of assumptions are going to have. As you know, most of the public agencies' valuations come out end of July, 1st of August, around the first week of August. And those will be the 2024 valuation results. And we're in the process of trying to determine, as we're wrapping up those vals, what the impact of all these changes are going to be with those valuations. So we're trying to get all this work done at this point. But what we're seeing right now, I would say generally, normal costs for, say, miscellaneous plans the impact is definitely less than 0.5% or so. And obviously for Pepper miscellaneous to be even a little bit less. On the safety plans, we're seeing impacts closer to around the 1% or so median impact for the safety plans. Obviously, again, with Pepper plans, that impacts a little bit less. In terms of funded status and liabilities, the impacts are not too much. We're seeing impacts generally for the whole system of less than 0.5% on the funded status. So liabilities are going up a little bit, not too much, with all the assumption changes. A little bit on the miscellaneous normal cost, and a bit higher with the safety plans. That's primary coming from, safety plans have higher benefits, and then the retirement patterns for safety members occur a lot earlier than generally the miscellaneous. And so you have higher benefits being funded over a shorter working lifetime. And when we make any type of adjustments, those changes gets translated into the contribution rates. Next slide. And these are next steps. I think Simone was going to talk about these.
I think I'll take them back, Scott.
Okay, Mike has those.
Yeah, so just this slide gives you a handy view of what's coming over the next few months. First up, there's going to be another webinar on September 8th, and you'll get to see Scott again. This is his annual webinar, really, where he really walks through the investment returns and what it means for you as an employer. I assume many of you saw that we announced our investment returns at the beginning of this week. They were very strong for last year at 11.6%. So we're very pleased with those in terms of our performance this past year. And he'll talk more about what that means for your rates going forward at that webinar. So when the slides come out, you'll have a handy link where you can register for those. In September, we're going to be discussing the ALM process, both in our investment committee and the finance and administration committee. First off, in the investment committee, you'll see us with our recommendation to the board, kind of a first reading, which means that we don't expect the board to act, that they wouldn't act until November, but we'll have sort of those key decisions for them laid out in terms of adopting a reference portfolio, as well as kind of an active risk limit in terms of how much the investment office can deviate from the portfolio. In the Finance and Administration Committee, you'll hear from Scott and his actuarial teams going through the experience study in more detail than what he just gave you. Again, a first reading, so an information item only. There's also the funding risk mitigation policy discussion that will happen. For those of you who have been following CalPERS for the last few years, this is the policy that in the longer term, years ago, it created an affirmative active reduction in the discount rate whenever we exceeded when our returns exceeded the discount rate by more than 2%, which was this past year. A little bit ago, our board changed that policy to go from an immediate non-discretionary change in the discount rate to more the opportunity for the board to discuss whether or not it made sense to lower the discount rate. So as I just mentioned, our returns this past year were in excess of the 6.8% return at more than 11%. So we are, under the funding risk mitigation policy, required to bring an item to the board that technically could be an action item. That being said, I do not expect, nor have I seen any evidence to date that would suggest that the discount rate is going to change. Obviously, our board retains that authority, but there's no reason to think that the board would be acting to change the discount rate off the 6.8%. So that was, I saw one of the questions that came through on the Q&A that I hopefully I answered the question, but if not, we'll have time for more Q&A in a minute. So, and then looking to November, basically the same structure of the investment committee and the finance and administration committee will do the second readings of the items that we first hear in September. So, you know, those will change to the extent we receive feedback. As far as feedback goes, you're always more than welcome to provide public comment, either during our board meetings or in writing. And with that, let me turn it over to Simone to bring the webinar to a conclusion.
Thanks, Michael. So this slide just shows some helpful resources. If you have additional questions after the webinar, you're welcome to reach out to our stakeholder relations mailbox. We also update our ALM page with all the materials that have been going to the board over the last year. And then if you have additional information, or if you have additional questions on the process, you're welcome to review our ALM policy. Both of those links are provided here as well. There were some questions in the chat on whether or not the slides would be provided. Yes, following the webinar. And once the YouTube link is posted, we will send that out to everyone that registered for the webinar. So you'll have both the slides and a link to the actual video from today. So that concludes the prepared remarks that we have. But if you have a question, you're welcome to raise your virtual hand and we will call on you. It looks like we do have some questions in the chat, but I think Michael actually responded to all of them. They were related to the discount rate. There is one question for you, maybe, Michael. Why would the board not change to TPA?
Sure. No, it's a good question, and obviously I can't put myself in the position of being a board member, but we think it makes a lot of sense. Ultimately, we're telling the board that under a TPA approach rather than a strategic asset allocation, we can perform better, increase the likelihood that our returns are going to be higher compared to our current process. So from a board member perspective, if we're able to deliver that, there's really no reason they wouldn't approve it. That being said, we do still have more work to do in making the board comfortable that they're going to receive the information they need to provide their oversight role and hold the investment office accountable. So we definitely still have work to do, but we think moving to a TPA makes sense for the investment office and for CalPERS more broadly.
Thanks, Michael. Are there any other questions for the group? I'm not seeing any more in the chat. Oh, looks like JJ, your hand was up and then it was down, so go ahead. You're off mute.
On slide 11, you said that the value add with the same risk by asset selection would increase the returns by 0.7% or 70 basis points. Why, if you're taking the same risk, why are you going to get a higher return?
Yeah, I mean, I think the simplest example would be, so in this reference portfolio, it's all public markets. So if you think about private equity, historically, private equity's outperformed public equity with a similar type of risk. So if you sort of use the example, okay, CalPERS has continued to invest in private equity. We would expect for, once you adjust for, you know, a similar type of risk, it's going to outperform the public markets, stock market per se. So this line is trying to capture that concept that there are opportunities outside of a passive portfolio that you can add additional returns.
But public equity in general, I mean, it's smaller, it's more highly leveraged, it is illiquid, all of which Farmer Branch says should return more because of the higher risk, and yet you're just telling me that it has the same risk. What am I missing?
No, we will adjust. We acknowledge that it has some higher risk, and internally we'll have those type of risk adjustments that we'll run through to make sure that wherever we're putting, and obviously not all private equity is the same. Buyout's different than venture. So in each of those strategies we endeavor into, we will make an internal adjustment that will be reviewed by the board's consultants to make sure we're kind of playing fair in terms of what the equivalent risk is. But long term, the private markets have provided greater returns when you adjust for risk than the public markets.
Well, I'd say that's debatable, but we won't have that debate here. At the offsite, you said you're going to hide the funding mix, at least to the beneficiaries. So is that not moving away from greater transparency towards greater secrecy?
No, what we said at the offsite is there may be some components of individual strategies that we don't disclose publicly. We'll still provide the same level of asset class mix that we do today. That's going to be publicly available, but we'll continue to not disclose anything that we think will infringe upon our ability to effectively provide the beneficiaries good return on their investments. But you'll still have the same level of disclosure in terms of where the funds are.
That's not what you said at the offsite. And I'd refer you to table 17 from the offsite. But again, let's move on. If the reference portfolio doesn't reflect what you're actually investing in, then what's the rationale for saying we're going to evaluate the board based on how they perform relative to this portfolio that they're not using? For example, big part of the reference portfolio is public equity.
Yeah.
But you've said we're going to do private equity. So private equity, given the various pharma French constraints, should outperform. So should we say that the board is doing well because they're taking this additional risk versus the portfolio, or do we make some adjustments?
No, we'll obviously make the adjustments, and I think my point was more the board being able to determine whether or not the investment office is performing adequately or not will become more transparent. So, but no, everyone's going to know that, hey, we don't want to just perform at the reference portfolio. That's on this slide. We don't want to perform at a 6.2, 6.3, 6.4. We want to perform long term at least at our discount rate. So that's going to be the expectation of the board, I would presume. They're not going to care if we achieve the same results as a passive portfolio, because if I were the board, I would then question, well, why do all of you exist with all of the costs and salaries of the investment team if all you're producing is the exact same results that we could get from the reference portfolio? The expectations are going to go up that we're still able to perform with that value add you see on this middle line, and it's just going to be more obvious that there's a single benchmark where we start the comparison of are we doing a good job or not now. And as you know, JJ, right now we've got 11 different benchmarks, and so it's hard to sort of even know which one you're talking about when you're looking at, well, did the team perform or not perform as a team? And so we really want to kind of move to a much simpler comparison. But the bottom line is our expectation as a team is we perform at the bottom line of this chart, not at the top line of this chart.
Okay. Currently, right now, you have one benchmark. You have sub benchmarks for the different asset classes, but you have a benchmark for the total portfolio.
Yeah. So if you think, so that benchmark does not change. And the benchmark. I mean, if you're talking about the built up one that builds up from the 11, then that's slightly different. But our benchmark ultimately is the discount rate. That's our mission as an investment office, is to hit the total fund benchmark at 6.8. And so it really is just rearranging how you measure whether or not we're doing that. We think it's going to be easier. You might disagree, but long term, I think it's going to be more obvious, more transparent as to what decisions we've made to deviate from a reference portfolio. And then you're obviously free to question the wisdom of any of those deviations. And then longer term, people will be able to say, oh, CalPERS made great investment decisions deviating, or they made horrible investment decisions deviating. I'm hopeful that it's the former, not the latter.
Well, and you know me, I've got lots of other questions, but I'll stop and not dominate it. Thank you.
Thanks,
Thank you.
JJ.
So it looks like the next question is actually going to be for Scott. So Scott, can you let the group know when will we announce the new UAL numbers for each jurisdiction based on the 11.6% return?
Okay, actually, the return 11.6 is a 6/30/2025 number. So those actual numbers and updates, it won't be reflected in your valuation until the 25 valuation, which comes out in 26. So you won't actually see the impact on your UAL and the numbers specifically, basically until a year from now. Because you know, the year just ended. We have to line everything up and then redo all the valuations, and that will come out basically the process next year. What Michael mentioned about the webinar in September is it's an opportunity for us to come out and kind of show you the impact that you're going to have on your expected rates, you know, based on you know, our estimate of particular plans, the returns we got, and trying to incorporate to the extent possible any impact on the assumptions. If you're trying to look for a really quick estimate right now, you can go out and use Pension Outlook. Those will be based on the 23 results, because those haven't, the 24 haven't even come out yet. Usually the 24 results will be coming out next month. We'll update Pension Outlook as soon as, you know, basically as soon as we can, once those results come out. Generally, we try to get them updated August, September at the latest. And then everyone can use Pension Outlook to try and look forward and make some estimates specifically for their agency on the 11.6% return.
Thanks, Scott. There's one more question for you. So it says, are there changes to assumptions that resulted from recent tariffs, policy, big, beautiful bills?
No, when we look at assumptions, you know, we look at the experience of, you know, demographic experience in terms of primarily mortality, termination rates. The one thing, you know, you might be thinking of was inflation impacted by the tariffs. You know, when we look at inflation, you know, we take a longer term perspective on where inflation's going, and we look over, you know, what's the 30-year, 20-year, 10-year expectations, what's happening with the CPI, what's happening with the CEP producer indexes. We try and look at all of those when we're looking at trends. We try and ignore the volatility that goes up. If you remember, CPI was well over 8% a year or two ago, you know, and it's come down. It's still, depending on your measure, around 3% to 7 to 8, somewhere in there, depending on which measure you're using. But inflation is, you know, have come down. In terms of tariffs, you know, that may be a temporary thing, that may be a long-term thing, but right now there's no, you know, hard data on the impacts of that, because basically, you know, tariffs are still being discussed and talked about and determined as we speak right now. So, you know, maybe 4 years from now, when we do the next ALM cycle, we'll have a chance to look at that and see if there's any long-term impact on inflation.
Thanks, Scott. So I'm not seeing any other questions in the Q&A or a hand raise. So I will take this as an opportunity to thank our panelists today for their insights on the ALM process. And we look forward to seeing you hopefully at the returns webinar in September. We also have another ALM webinar that is scheduled for December 4th. If you want to log in and better understand the board's decision that they made on the ALM process and how that will impact you. Otherwise, you have our email if you have any additional questions, and we thank you for your time. Have a great day. Bye-bye.